What's up, guys? Welcome back to Markets with Mizzy, where I bring fundamental market and economic knowledge at a no-cost price so you can deeper understand the market, your strategy, and the economic environment. As I'm sure many of you are aware, in the trading community, it's very popular to preach, risk 1 to 2% of total account per trade as a risk management, but that's very surface level. And what you need to understand about this isn't about how much you want to risk, it's about how much you want to survive. Confused? Well, just let me explain. First, I'm going to explain the Sharpe ratio. It's used to determine an investment's return relative to the risk taken for the investment. It measures how much excess return an investment earns per unit of risk, which is typically measured by the investment's return volatility. So to put it in simple terms, it'll estimate how volatile your returns are going to be and how far your outliers are from your mean. I do want to make clear that the Sharpe ratio is the volatility of your returns, not the volatility of the market. But with a volatile market, a low Sharpe ratio will make your returns even more volatile. Looking at this chart here, you can see you have two strategies, both which return 12%. One has a smooth equity curve and one has an extremely volatile equity curve, right? The path is very bumpy to get there. So the one with a smoother equity curve will tend to have a higher Sharpe ratio because it's more stable through volatility, right? It survives volatility better. And the more volatile equity curve will tend to have a lower Sharpe ratio because it struggles to stay stable through volatility. And you end up taking on more risk per unit of return. So I want you to ask the question, is the return worth the risk I am assuming? This brings up the survival part I was talking about earlier. It's crucial that you have a good Sharpe ratio with your strategy because it makes surviving volatility easier and makes your returns more consistent, which is key to succeeding in the market. Especially now, as you know, with our global political environment, there's a lot of heat around the globe and a lot of things constantly happening and changing, and it creates a very volatile environment for traders. So now I'm going to give two keys to success, which is being consistent and being repeatable. I know that there's a lot of talk about win rate percentage of risk and how to be profitable with your win rate percentage and your risk. And looking at this chart here, you can see the different combinations. While this is a good starting point, it's just the tip of the iceberg and kind of gives you just a guideline of what you need to do. So people often say, I take one trade a day with an RRX with two contracts, which is just far from consistent. Consistency does not look like not overtrading, 2 contracts max. Consistency does also not look like sizing up. 8+ setup calls for it. Now, I know a lot of people are going to disagree with me on this one, but if you have to change your sizing based on the rating of the setup, either A, you're not being consistent with your setup parameters and your conditions, or B, you are very emotional and don't know how to properly size. Especially if you've ever said anything along the lines of, I feel the market is going to do this, you seriously need to rethink twice.
Talk to really experienced and successful traders and you ask them how they know what's going on. They can't give you an answer. They don't know. They feel it. They can feel the way the market's moving.
For most retail traders, a good rule of thumb is going to be to risk the same dollar amount or the same percent of the account. So for example, if you have a $50,000 account and you are risking 1% of the account per trade, this would be $500 per trade. While you may not be on the dot of $500 every single time, it's good to stay consistent as possible and then scale when necessary and continue to stay consistent. The next thing I'm going to talk about is what I've deemed the term true RR, which concerns taking profits early or cutting losses early, because unless you have certain parameters that are back-tested and confirmed that they will result in a loss or a loss while you're in profits, there's no need to be doing this. Let's say you take a 1 to 2 RR and you quote unquote secure profits early to lower risk at 1 to 1. You have now statistically still assumed the same risk you originally did, but you've managed to lower your profits. So your RR was 1 to 2, but you didn't win a 1 to 2 RR trade if you did win. Your true RR was now 1 to 1. Now, it's not exactly the same if you take a loss early to avoid a bigger loss, because theoretically you have assumed less risk per unit of reward, but now you've managed to destroy your model, which this goes for both sides as well. If your model is built on a 1 to 2 RR, it's probably for good reason it isn't built as a 1 to 4 RR, or you would probably do that every time. You need to have a consistent RR for your model to help escape randomness of returns. Don't change it after entering your trade, as the conditions for your trade have already been met. If you do anything after you place the trade, like cut losses early or take profits early, you're not even following your model, right? It's unpredictable and inconsistent. And so the sizing and RR both go back to the Sharpe ratio. Consistency and the ability to repeat your trade in a consistent manner is crucial to surviving volatility and have consistent returns. If you want to know how to calculate your Sharpe ratio and optimize RR and win rate, or anything else you want to see, leave a comment below. Thanks guys for tuning in. I hope that you've learned something and you have something that you can keep with you. And make sure to like, subscribe, and hit that notification bell so you don't miss the next video.